Alright, we should be back. We should be back. This is like way better. So much smoother. Computer always acts weird when I have my little AI programs running in the back. It takes up a lot of resources. And then on top of streaming, it's just not good. So, my computer is good, not that good. Not that good. Can't be running everything in the background there. Alright, anyway. Now we're 3 minutes out from Powell. Let me just make sure we pull that up as well. Let's see. Associated Press got it. We'll try that. Oops. Oh, nice. They got it. Nice. I love it when they have the Powell live streams have a live chat. Because the Powell live stream chats are always funny. Thing really just missed TP. Alright, NQ still chilling for me, still in profits, beautiful. Again, Powell should be coming up here in about 2-3 minutes. Usually takes them a little bit to walk over to the podium there. I'll hide that for now. Actually, let me do this too. This over here. Here. Which stream has the Associated Press live stream has it. If the standard news channels like Fox and all that will have it disabled for sure, but Associated Press has it enabled. You can check out the chat there. They have 5,000 people watching, so it's probably a bunch of degenerates in the chat yelling XYZ is pumping or buy this, sell that. It's like literally all the chat says. So it's like, look, yeah, long Bitcoin, long NQ, buy XRP. People in there, I'm sure, protesting the war. It's always a good time. Always a good time. Again, I'll bring that up here in a second. Once Powell starts to walk out. Again, I am still long NQ. I am chilling at break even. Some people are also riding oil buys, which again has now just officially smacked TP. Or at least TP1. Again, TP2 is up closer to the 75 level, which again, Powell could expedite price up there, but please, please, please lock something in. If you guys took that from this morning. Not even this morning. When did I send that in chat? 11:34. Yeah, so like 3 hours ago. And price was down here, so. Beautiful, beautiful, beautiful position, though. Again, also one that I did not take, so I'm not, you know. Unfortunately, I'm not profiting on that, but such is life. Alright, let's see. We're starting to bring Powell up here. Let me switch this over. Actually, you know what? Let me do this. Alright, y'all, can y'all see him there? Oh, maybe not. There we go. Well, I know you guys can't hear him. One second.
The unemployment rate remains low, and the labor market is at or near maximum employment.
Let me turn him up a little bit.
Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I'll have more to say about monetary policy after briefly reviewing economic developments. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP as we call them, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.4% this year and 1.6% next year, somewhat slower than projected in March. In the labor market,
I don't know if
conditions
it's
have
just
remained
me, but I've
solid.
never seen them overlay
Payroll
a
job
chart on
gains
this ever.
averaged 135,000 per month
That was
over
weird.
the past 3 months. The unemployment rate, at 4.2%, remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.5% at the end of this year and next, a bit higher than projected in March. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.3% over the 12 months ending in May, and that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 3%, somewhat higher than projected in March. The median inflation projection falls to 2.4% in 2026 and 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to trade, immigration, fiscal, and regulatory policies continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year, the same as projected in March. The median projection declines to 3.6% at the end of next year and to 3.4% at the end of 2027.
Yeah, I was just looking at this. I'm going to pause this for a second, just to highlight this in more simple terms for people. So a couple of things changed from March in terms of the Fed. This is like what he's going over right now, the little dot plot here. First off, over GDP, revised down, so they're expecting the economy to essentially grow slower, right? It's not that it's not growing, it's growing slower. They see inflation being higher, they see unemployment being higher, and as far as this dot plot goes, they're expecting rates to stay higher for longer, right? So they made some adjustments, not so much to this year, or like kind of going into like the next year. They're still looking at about 2 cuts, but into 2026 and 2027 and beyond, they're looking for a little bit higher rate. So again, they're just kind of expecting this inflation and unemployment. I mean, both inflation kind of going higher, unemployment going higher. They're really just seeing no reason to lower this to the expectation that they were previously. So kind of interesting. They're kind of flashing a few bad signals.
A little higher than
and expecting kind of rates in the longer term to stay higher. But this is kind of the safe path for them. Again, until they really know what the effect of tariffs are going to be and possibly this war. He hasn't commented on the war yet, but I'm sure somebody in the audience will ask him in a few moments here.
In businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
All right, here we go on questions. Some of these questions are just stupid, so.
To what extent has the more limited impact from tariffs at this stage on inflation changed your view on what the ultimate economic fallout will be from these policies and the timing of when they will materialize in the data?
So we've had 3 months of favorable inflation readings since the high readings of January and February, and that's, of course, highly welcome news. Part of that just is that services, core services, both housing services and non-housing services, have really been grinding down toward levels that are consistent with 2% inflation. So that's the good news. We've had goods inflation just moving up a bit, and of course we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months. We do also see price increases in some of the relevant categories like personal computers and audiovisual equipment and things like that that are attributable to tariff increases. In addition, we look at surveys of businesses, and there are many of those, and you do see a range of things, but many companies do expect to put all or some or all of the effect of tariffs through to the next person in the chain, and ultimately to the consumer. Today, the amount of the amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more. And we think our policy.
So he said all of that just to say, just to say, I don't know. That's what he's saying. He's saying is I don't know when it's going to be. Because her question was just how long is it going to take to see this in the data? And he took the long way of saying I don't know.
There's this expectation that underlying inflation will just stay well enough contained that allows the committee to eventually move ahead with those cuts? Or is it about responding to a deterioration in economic activity, let's say? I mean, how should we make sense of the forecast?
So if you look at the forecast, you will see that people do generally expect inflation to move up and then to come back down. But we can't just assume that. Of course, we don't know that. And our job is to make sure, one of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping.
So all you need to know about anything that's being said right here is as long as inflation stays below and I've said this multiple times, but as long as inflation stays below 3.5%, nothing any of these people are asking right now even matters. It doesn't, like, to their point, they see it going back up, they see it creeping up a little bit. If it gets above that 3.5% mark, it'll be an issue. And from what he's saying, again, it's minuscule. It's not going to be a long-term problem. Or at least they're trying not to make it a long. It can escalate into that, but
Persistent inflation.
as long as it's below 3.5%, don't even worry about it. It's a non-issue.
Why are you on a slower path now?
So I would focus most on the nearer term. As you get out to the later years, it's hard for anybody to know where the economy is going. You didn't see people moving their longer term, estimate of the neutral rate, for example, at this meeting. So and those things are probably slow moving. So I think if you since March, this is since March, right? You see a little slower growth, just a tiny tick up, a 1/10 tick up in unemployment, and you see inflation moving up 0.3. And by the way, it was a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April, after the March meeting, that substantially higher tariffs were likely, and then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time, and what you see is an accumulation of individual assessments.
You say in the statement that risks have diminished on that front, but the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East adversaries with a possible U.S. involvement. How can you justify saying that risks have diminished?
So what we said was that uncertainty uncertainty about the economic outlook has diminished but remains elevated. Many surveys say that. They do. So, and that's actually a line from the Teal book, which you can see in 5 years. Remember to check that.
Maybe the world will be over.
So link him to reference that in
if you
5
think about
years.
it, tariff uncertainty really peaked in April, and since then has come down. And that's really what that's just acknowledging. It's diminished, but still elevated. That it's uncertainty. So I think that's an accurate statement.
Again, this is just like he loves to say I don't know in just the longest way possible.
Thank you. Chris Rugaber, Associated Press. There is an argument out there in favor of cutting rates more immediately. Inflation has continued to cool and is back to roughly 2% despite the tariffs. And I guess I also wanted to ask about cracks in the job market with gross hiring slowing, concentrated in just a few industries. We've seen some housing data, including this morning, that's been pretty weak. Do you see any concerns that the economy is weakening and that is a reason to cut rates going forward?
We do of course monitor all those things. I think if you look at the overall picture, what you're seeing is 4.2% unemployment and an economy that's growing at a rate hard to know given the unusual flows in the first quarter, but it appears to be 1.5%, 2%, maybe a little better than that. Sentiment has come up off of its very low levels. It's still depressed. So you can point to things. The housing market is a longer run problem and also a short run problem. I don't think it's indicative of, basically the situation is we have a longer run shortage of housing, and we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a sustainable way and create a strong labor market, and that's the best thing we can do for the housing market. You asked about the job market. Again, look at labor force participation, look at wages, look at job creation. They're all at healthy levels now. I would say you can see perhaps a very, very slow continued cooling, but nothing that's troubling at this time. But we watch it very, very carefully. So overall, again, the current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments, and for now, and we'll be watching the data carefully.
Well, just quickly on, given that there are concerns inflation will rise, but there is the alternate scenario that tariffs would create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do you see odds of that scenario? What kind of odds do you see of that scenario coming true? And how many months of cool inflation
That
would you need
is
to see
so-
before concluding that maybe that lower inflation scenario is taking place?
So this is very much the conversation we had today and yesterday. There are many, many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we think, and where the labor market does or doesn't soften. And I think what you see people doing is looking ahead at a time of very high uncertainty and writing down what they think the most likely case is. No one holds these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for any of the rate paths, I think, that you see in the SEP. And, we do this once a quarter. It's a hard thing to do particularly at this time. But it does reflect, if you see somebody writing down, a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts will be appropriate. And it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
So he's kind of shutting down the idea that there's any data that could speed this back up, since they kind of slowed the rates. What's interesting to me, I was kind of just jotting down things that he said. Like housing is irrelevant. We know that. We don't pay attention to the housing prices. I let the real estate agents argue over that bullshit on when's a good time to buy or not. They're always bullish houses. I could care less about housing for the most part. In most market conditions, again, focused on the labor market. That we've been talking about this for months. Like, their focus very clearly isn't on inflation. Like, there's some risks of inflation because of tariffs and the war, and that's the only reason they even remotely think inflation's gonna go up. Without those external factors, without just Trump being Trump and just kind of going out there and threatening countries with tariffs so they don't do what he wants to do. Without that, inflation's not even a concern for them. They probably wouldn't even be looking at it. It probably would be no risk of returning to the upside. So really, Trump's the only thing that really is and again, you can argue all day on whether or not tariffs will cause inflation. The average everyday person will say tariffs hurt them because their grocery store prices have not went down. Here's the reality. Your grocery store prices are never going to go down. Once they go up, they're up. They might go down in the sense that companies run deals and some things become loss leaders, but once inflation is priced in, it's priced in. There's no situation in history where eggs went up to $8 and then back down to $4, and then eggs are a bad example because they're companies will eat losses on eggs to get you in the store. So people are oh, we want 99-cent eggs. The price of eggs are never 99 cents, but companies will eat the $2 loss on that because they want your ass in the store. It's a marketing tactic. But generally speaking, your prices won't go down. They go up and then they just stop going up at an expedited rate, right? That's 2% inflation means that there's always inflation. They're not looking for negative percent inflation. It's never the goal. It's not even really achievable in the way that the economy is set up. So again, the focus on the labor market and them saying it's not troubling, I think is interesting. He keeps mentioning this 4.2% level, which is where we're at now. Again, it is historically pretty low. They still think this coming up to 4.5, right? They have this coming up to 4.5 by the end of this year, if not the end of next year. I think he said. So it's interesting. Again, this is the only data. If this is where their focus is, that's where my focus is. How is the labor market going to be impacted? And there's a few things about the labor market too that I think are super interesting. That I think maybe somebody will ask him, but I'm not going to continue to listen to him because we're getting to the period where he says the same thing to the same people, just 20 different ways, and nothing really else new comes out. But what I think is interesting too, that's currently going on, is and I'm trying not to take a position here. I'm just trying to give you guys the facts, but we know that Trump is for mass deportations, right? And this is something that could does affect the labor market, right? Because technically, if people are being, and NASDAQ's just tanking, being deported and jobs are opening up, the question then becomes like, do people go to fill those jobs, right? Like, again, if ICE raids all over California, a bunch of farms and factories and like all this shit, and like, a bunch of construction crews and, honest people just trying to do their job, but at the end of the day are getting caught up in this weird political battle. Again, like, what happens to those jobs? Does the roofing industry in California, does that drastically change? Does the construction, like, do they fill those jobs? Do those jobs just remain open? Do they get filled? Does that help with unemployment? Does it not help with unemployment? Like, it's a big factor, because when you're talking about a certain number of people in very specific demographic areas, it can impact the consensus. So I'm curious how that kind of plays like an effect on this, because I do think that this goes up towards like 4.5, 5%. I mean, that was kind of been my expectation the past year or two, but at the same time, like, jobs might become more readily available because of that. Again, just the reason that they're becoming available. Again, I know people have like emotions around, but it's a real thing. Like, again, if you raid the construction site of every place in Florida, and you round up even like 40 to 50% of those workers, like, that's a lot of empty jobs that then again do have to get filled to some degree, which affects GDP and affects unemployment and affects all these little statistics. So I'm curious if he says anything, or if anybody brings that up. Again, they try not to get super political. Like, Powell will do everything in his power to avoid answering that question and like taking an actual stance on it, especially because him and Trump are like not buddies. This dude's lucky to still have his job, honestly. He's lucky Trump didn't do something to put somebody else up here as soon as he got in office. So yeah, definitely interesting to see. Again, I'm gonna keep my eye on like news articles to see if there's any comments on that, but it doesn't seem like they're really expressing too much other interest here. Outside of that, in terms of the market has done really nothing. Pretty boring day. I'm probably gonna get hit break even on this position here. S&P still falling, gold falling, oil. Again, it still hit TP here. Fantastic, awesome. Again, I think if you're trying to hold this for TP2, you're kind of dreaming. I would take your money on this if you guys are in it from this morning. Yeah, I'm about to get taken out on NQ. So yeah, I'm gonna pretty much wrap my day there, and I will be back tomorrow morning, 9:15, bright in the morning for our live trading session. Yeah, appreciate y'all, family. It's your boy Skag. I'm out of here for now. Enjoy the rest of your